afternoon, Matt. Good to talk to you again. I'm Elaine Ellingham, CEO of Omai Gold Mines. We're traded on the Venture Exchange under the great symbol OMG. So we've been moving forward on our project down in Guyana, Guyana being in South America, and past producing mine, and been working and have put out 343-101 resources, as you know. Most recently, last year, 2 million ounces indicated, 2.3 million inferred. We've drilled 30,000 meters since then, and so we're just working our way up to that next resource, which we think is going to be quite substantial.
Well, good to see you as well, Elaine. There's the topic of conversation is the new resource. Obviously, a lot of drilling happening, and a lot of different types of drilling as well. So, I mean, several of the the drill holes show sort of high grade mineralization outside of the 2024 MRE pit. So, can you just sort of break down the drill model, as it were, so we understand what you're chasing?
Yeah, so there are two deposits on the property. As you know, there's the intrusive hosted, and then 400 meters away, there's the Wenot Shear. So we have focused our drilling on the Wenot Shear. It's like 2.5 kilometers long. Most of what we did previous to last year was above 350 meters, but we've been, after we proved it was shallow, now everyone says, does it go deeper? So we've been drilling deeper. So so we've drilled about 30,000 meters on since our last resource. Pretty exciting stuff. Yeah, and as you say, one of the milestones for us, I mean, historically, the Wenot deposit reconciled at about 1.67 grams per ton. So obviously, and we've proven it gets higher grade at depth, but last fall we started hitting some very wide intercepts, like 4.5 grams over 57 meters, and 3.16, I think it was, over 68 meters. So that kind of changed the game. So we went, it's like having a mine within your mine. And so we continued to step out on the 2.5 kilometer deposit, but then we did tried to explore that higher grade zone to see, exactly how big is that and what's the extent. So that's been exciting.
That's been, but can you sort of break that down for us in terms of, look, you're also sort of, I guess you're moving towards PEA at some point once the resource comes out as well. So what's the point at which you start to do more of the conversion type work, and when you kind of tone down the step out expansion? Because I'm not quite sure what's getting valued in the market at the moment. So maybe you've got a view on that.
Yeah, I think it is. It's all about what creates the most value for our shareholders, and we think about that a lot when we're working on things, for sure. So I think that showing like the property as a whole, between the 2 million and for 2.3 million indicated, that's a fairly substantial number, obviously. But you're in a new country, Guyana. It does have some large scale mining and some very great large scale projects that are in the works. You do want to see multi-decade mines in this environment, and remember, this was the largest primary gold producer in South America when it was in production, so we think it can be there again. So I think the value is proving, or at least an initial, how big is Wenot. And so this year since last year, it's been about how big is Wenot, and we've been focused on that. So you're right, we could have stopped and done infill drilling, but I believe there's more value in exploring exactly how big is that Wenot deposit, right?
So, but what are you looking for? Some new structural trends in there, or in fact, are any emerging? What are you starting to see?
It's actually a fairly simple shear hosted. So the dominant shear direction is more or less east-west, and there's just multiple vertical zones. There was a lot of deformation. So even people that worked in it when it was in production commented, how continuous the zones were along the deposit. That said, we have learned that there are some subtle cross-cutting structures. We know from some of the marker horizons that it doesn't offset it laterally or vertically, but they were critical, I believe, in some areas to bringing in the gold-bearing fluids. So in some places, I think we have a good understanding, and being able to predict and the controlling mechanisms is important, because it means you can be very effective with your drilling and in expanding the resource. So the cross-cutting structures, in some areas, definitely they are showing us that we have enriched gold mineralization there. but it doesn't detract from the general east-west shearing where there's mineralization.
And in terms of just sticking with the drilling for a bit, if you don't mind, obviously, so I'm intrigued how you once you're sort of chasing uh, the zones like gap zone or east where not do you how do you kind of quantify or measure what it is that is going to be potentially capable of being included in a future open pit or underground mine in terms of grade or width thresholds, things like that?
Yeah, that's a really good question because the cutoff grade that we used in our resource in our PEA last year was 0.35 grams per ton. We probably, I mean, I know the gold price is up 50% since then to a lofty area. I still don't think in this iteration, I don't really think we're going to be bringing that grade down. And also we've done sensitivity studies and even raising the cutoff doesn't really reduce your resource. It would not. It's the mineralization, you're in it, you're not. There's not a lot of marginal low grade. So the zones are very substantial. You're in it, you know it, there's a visible gold. So often, I mean, obviously when you're getting intervals that are 4.5 grams over 57 meters, that's a mineable horizon. For open pit mining, I think in our PEA we use blocks of 5 meters. So in other words, if you had a 1 meter wide zone in an open pit, you would expect that you're going to have to add 4 meters of dilution. But basically, where the economics suggest is that anything above 0.35 grams per ton is worth putting through your mill.
Okay.
And as you know, I mean, when you look at I'm sure you talk to lots of people with projects in Nevada and other places, and sub 1 gram material is mined. I think sub 0.5 gram material is mined. So, it's all about economics.
Yeah.
So we're not bumping along the bottom of what's economic.
But you raised a couple of interesting points there with regards to this was a big mine in the past and it can be a big mine in the future, and with gold price like this, increasing margin changes optionality. So if you look back to the previous PEA, for instance, are you running sort of internal scenarios, modeling sort of increased production beyond the kind of 9,000 ton per day that you currently have or previously have used?
Absolutely. Yeah.
Right.
Absolutely.
Okay.
And I think we've talked about that. I mean, we did that resource really to show shareholders that there was a path to production. The juniors were kind of in the doldrums. We thought, we had a spectacular resource, but we weren't getting market recognition and the valuation. I think when we put that PEA out, it was only on 45% of our resources and one of our 2 deposits. So we just put a PEA around the open pit. And it came out with a net present value of $560 million US at a 1950 gold price. So it was effectively a wake up to the market to tell them that, that this is a project that can go forward, right? Or we believe can go forward. This next PEA, we're going to have a much expanded Wenot resource because that was on the Wenot before, but we're also bringing in the Gilt Creek underground deposit as well.
Right.
So that 9,000, we're hoping that it's going to be in, as high as 15,000 ton per day plants, something like that.
Yeah, it's going to be interesting actually. So you've kind of got well over 90% of production is from above 330 meters. So I guess I think the thing will be like on the market will be looking forward to trying to understand how sensitive the PEA model is to kind of strip ratio increases at depth, and what are the variables that you're chasing to make sure you're sort of stay on top of that, as it were.
Yeah. So I mean, definitely. So there's 2 things that are working in different directions. One is, as you said before, when we drilled initially, there were a lot of areas that we hadn't closed off, even right within what was in the PEA pit. So our strip ratio was artificially high because we hadn't finished drilling off the deposit. So we've done some of that. So that would bring it down, the strip ratio down. But as our deposit gets deeper, you're correct. In the mining, the strip ratio is going to go up. I guess one of the things we point out is, when you look at the grades we're intersecting and the widths at depth, with a strip ratio, you don't worry too much when you're looking at, 2 or 3 grams per ton. Now, the other interesting thing about Wenot is that, some of those higher grades, we have sufficient data to show that it is increasing in grade with depth. Some of those zones, that they're certainly wide enough and higher grade enough to go underground. So during that PEA, we are going to have to optimize the economics to look at, do you take some of the upper, you start doing the upper Wenot open pit, and there's optionality. It might be economic to do some underground earlier on. So, and I mean, people who develop mines, they like the optionality of, having various different sources of ore, right?
Well, I mean, the reverse is true as well. Maybe there's optionality to incorporate satellite pits or additional surface mineralization as well. No.
Yep, absolutely. Were you reading our business plan?
No, no, but it just makes like I say the sheer scale of this.
Yeah.
And you've got to do those trade-off studies between the cost of capital and the kind of capex requirements up front versus like you say, the low-hanging fruit, as it were, right?
Yeah, and so because our QP was down at site, the qualified person, the independent consultant who's working on the resource, he made his trip last week. And so, we're full speed ahead onto that. So you have a cutoff because, they can only take so much of the data from Wenot in, and then they close off their model and run the numbers. So we have 3 drills turning right now. So 2 were on Wenot. So what we're going to do is we're kind of on the last hole we're going to do on Wenot for a while, but we're going to step out onto, as your crystal ball told you, onto some potential satellite pits. Again, that gives optionality, and near surface mineralization, especially if it's higher grade, really boosts your internal rate of return. It boosts your net present value, and it brings down your payback period. So we want to focus on those. We tend to focus on what's going to take us to the next tangible milestone, and it has been all about Wenot. And now once that's kind of passed off to the independent consultant, then we're going to look at some of those satellite zones. And then, and then you didn't ask me about what the other drill's doing.
Well, Elaine, what are the other drills doing?
So, the third drill started, we did put out a press release, but the third drill started on the Gilt Creek deposit, which is 400 meters to the north. And that's actually, that Gilt Creek deposit is what the Omai mine was initially built for. And so we are working on the underground extension of that. So we have 1 drill hole. We did 1 before Christmas, which was pretty spectacular. But we have a second drill hole. And so we're down at about, I think, 1,060 meters this morning. And so we've been drilling through that Gilt Creek intrusion, I think between 200 and 275 all the way down to just now. And we're going to extend that hole because that's going to go underneath the Wenot deposit, but down at about 1,100 meters depth. So this hole is basically to explore the blue sky potential, I guess we could call it, at depth underneath Wenot, because remember, they're vertical zones.
Elaine, that literally was the first question I'd written down in terms of how do you envisage the sequencing between the two. But you've answered us. Good. I was going to come back to it, I promise. But the thing I do want to come back to before I kind of leave the kind of PEA economics type portion of this questioning, which is, and I think I know the answer here, but when you talk about phased development, or potentially toll milling agreements, are those things that you'd look at, or do you think because of the kind of really positive gold environment and your relatively low capex, that's not something that you need to consider?
I think the key thing is you have to build a mill there, right? You have to build a process plant. And I think the big question is, how big is that plant? Because a big percentage of the cost of a big large-scale mine is the processing plant. So I think that's going to drive the overall cost, and so it's very much about optimizing economics. But just remember, it produced 300,000 ounces a year average pro forma, and I think that's a good aspirational goal to hit again, right? But again, it is how you want to develop it, and there are higher grade areas, and so you know, do you mine those first? It all comes down to optimizing that. And then, as you know, from a CapEx perspective, yeah, building these large scale mines, it's expensive, but look at the price of gold. And as you say, you know, and you're well aware, the inflation has not really kept up with the gold price. Like sometimes in the past when the gold price came up, the cost came up proportionally. Not so much yet. You know, touch wood. It's been it's great, and I mean the gold price now, it's far beyond what most of us we're happy. If it comes down quite substantially, we'll still be happy as producers, right?
That's like, yeah, I think inflation did keep up. I think it's maybe due to price gouging rather than anything else, but that was there. Just I guess the factor in all this people perhaps need to be reminded of is the kind of brownfield site component. It kind of reduces kind of permitting and permitting hurdles and environmental risk. So can you give us a sort of update on where you're at with the EIA and mining license?
Yeah, right, for sure. Yeah, and that was the other reason we did the PEA last year, because it got us on the path. And in fact, within 6 months of us finishing that, and that PEA, which had a mine plan, we provided it to the government, and we actually received an environmental permit. It's an interim one for 2 years, but I think it was a great milestone, especially compared with some of the other projects in country, and that also allowed us to apply for an EIA. So we just recently engaged ERM, which is a large international firm specializing in environmental studies for upcoming mines. And so they've started, and we're working with the EPA in Guyana, the Environmental Protection Agency, and they're very knowledgeable on Omai for sure. I mean, they have more history with Omai than we do, and they know the site very well. So yes, it's a brownfield site. There is another project that is just in country that's just been through the process. So the good news is, you know, sometimes you don't want to be first. So the path for these large scale mines has been sort of worked through. And so the one thing, definitely, you're right, the benefit here is we are a brownfields project. And so it's a cleared site. So it doesn't have a natural environment. The rainforest did not regrow. So there is we already did a biodiversity study. And again, there's no endangered species there. And it's not a natural environment, which they recognize. So yeah, I mean, even in Guyana, the permitting process is fairly quick, but I would expect us to be on the leading edge of that timeline.
And what about kind of the interim permit?
Sorry, what was that?
The interim permit. Is there a sort of 2-year interim permit?
Yeah, that just allows us to do some site preparation work.
Right.
And you know, we have designed the plans to do some of that. For example, dewatering the pit.
Yeah.
We've been kind of flat out on what we're doing, and a lot of people on site, and so that type of thing, we basically have all the components and the engineering done for that.
Right. Okay. You know, you said to me in the past that the government is very strongly, pardon me, very strongly pro-mining. What about local communities?
Yeah, well, there actually are no local communities to Omai per se. When it was in production, it was a very remote site, and that's what some people who have come down to site that were there when it was in production in the old days went, "Oh, I remember when we came here in the old days. It was so remote. Now it's not." As you know, there's a road. The main corridor that goes down to Brazil is only 10 kilometers away, and that's being paved. So. That's pretty spectacular access for any mine. And so there are communities when you get back onto that main road and head towards the capital city of Georgetown. So we've been in there and we've met with people there. They're fairly small communities until you get to Linden. And the people in the smaller community that's probably about 40 kilometers away, they do a lot of our work. They've helped us build like our new fuel tank systems and some of our core shack stuff and things like that. They have actually a lot of skill sets in that community. And obviously it's beneficial for us to work with them because they're closer than bringing in people from Georgetown, right? Linden is a great place. It's about 100 kilometers away, and it's a fascinating place. It's the second largest community in Guyana. And I think we've mentioned it before. The other thing is Something I learned relatively recently, I knew there was an open pit bauxite mine there, aluminum. It's been in operation since the 1920s, over 100 years. And it was discovered by Canadians, so I think we're always perceived as the good guys. But that is where your workforce is going to come from. And they've got 100 years of open pit mining experience, so it doesn't get much better than that.
This is true. This is true. It's in mining's history for sure. Just in terms of like setting people's expectations going forward, we've got a new resource. Is there timing for that? And also, I guess people want to sort of understand, where you are in the PEA process in terms of creating that data for it. When could they expect to see that as well?
Yeah. So the resource is going to be probably 6 to 8 weeks. We're hoping mid-August. We've tended to always deliver on time on these things, and so hopefully we can. I know it's the summer doldrums, but hopefully our consultants are willing to work with us there. So, and then we'll go straight into the PEA work. We've started some of that, but obviously it's reliant on getting that resource. So I think the PEA is probably reasonably 3 months after that. So 3 to 4 months, because remember, we're bringing the underground in this time, but we have already started a little bit of work in that direction. So that's sort of, those are main milestones for a company like this. Yeah.
Busy year.
Yeah, very
busy year. Big information. And you good for cash at the moment? It's going to run up to the end of the year for that PEA?
Yeah. So we're sitting, I think, at about 22 million.
Okay.
22 million. Yeah, we did a substantial financing in February at 30 cents, and I think we've traded as high as 62 cents already. So hopefully happy. Well, we always want happy shareholders. So I think,
I suspect they are. Up 6 times since the beginning of 2024. Not too bad. Not too bad at all.
I know every company says this, but we still believe we're undervalued when you look at the resources we have and sort of the prospects for moving it forward and the infrastructure and the support by the government. We still see that there's a lot of space ahead of us.
Okay. Well, keep at it. Keep doing it. And we'll talk to you, sounds like very soon. Appreciate your time today.
I was going to say, we'll probably catch up at Beaver Creek and we will have our resource out by then. So
perfect.
We'll probably be smiling.
I hope so. Okay,
take care.
Okay, thanks, Elaine. Bye.
Thanks. Bye.